Today, my name is Bond, Deposit Bond. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Kerry Henry from Aussie Bonds. Hi, Kerry.
Hi, Martin.
Great to have you on the show, and we're going to talk about something today which I don't think many people will really understand or even perhaps have heard of. Deposit bonds, but they are quite an important instrument, aren't they?
They are indeed. They've been around since 1989 and basically took the place of bridging finance, which used to be quite a cumbersome exercise back in those days to get in place and to be able to get the deposit to put on a new purchase. So yes, deposit bonds have had been around for a while, but still quite unknown by a large part of the market.
Right, well, before we get into the bonds themselves, why don't we just do a little bit about yourself? Long history in the finance area and a few other things too.
Yes, I've had about a 30-year career in corporate life, in insurance and insurance broking. I held general manager, director, and managing director positions on the insurance side, and I was also vice president of Citibank. So I've had a mix of financial services along the way, and in a couple of different countries around the world.
Great, and going back to the deposit bonds, normally what happens is when you buy a property, when you exchange contracts, you have to pass across, say 10% or whatever it is. That's real money going across from one side to the other, right? And most people will assume that's the only way to do it. But deposit bonds is a bit of an alternative track, and it has a number of features and some benefits. I think it's probably worth starting by trying to understand precisely what a deposit bond actually is.
Certainly. A deposit bond is a certificate. It's a piece of paper that is handed from the buyer side to the vendor or seller side, and the seller or their legal representative holds onto that certificate as the equivalent of having paid the 10% deposit. Let's just use 10% as the example. So there's no money changing hands up front. There's no finance involved. So it means because there's no money paid up front, the buyers have to settle with 100% of the purchase price. There's no cash. There's been no cash deposit.
Right, so that's a fundamentally different process then, because normally you hand across 10%, you then settle at 90%, and of course if anything went wrong, you've then got a battle to get that 10% deposit back or whatever. Here, you basically don't have to stump up any money until you complete. But I imagine that you've still got the same issue of if something went wrong and the transaction wasn't completed, you've still got to lose the 10%, presumably.
Yes, absolutely. Irrespective, as you said, cash or bond, if you forfeit on the contract, you're going to be out of pocket by the amount of the deposit. And what happens there is if you do default, the vendor side, the seller side, their solicitor will hand that piece of paper to QB Insurance, who backs the certificate. QB will pay the seller side the 10% or whatever the deposit amount is, and then QB will come after the buyer to get their money back.
Great. And is there a limit to how much what size of transaction you can actually protect through this deposit bond process?
No, it obviously depends on each person's circumstances, and bear in mind we do deposit bonds for both residential and commercial. So the largest one I've ever done is about $3.5 million deposit on a $35 million land bank that was being purchased for a development. So no, there's no upper limit. It just depends on each case-by-case circumstances.
Right, so what's the process? So if I'm thinking of going and buying a property, maybe at auction or maybe a private treaty, how do I engage around the process of getting a deposit bond?
Okay, well, let's just split that up a little bit there. Let's just talk about somebody who's going for an established property. They're going through the private treaty or for sale process, and they've got themselves unconditional finance approved or pre-approval subject to valuation. They complete an application form, a couple of support documents like a copy of the contract, photo ID, proof of the finance from the relevant funder, and then we issue the deposit bond. If someone's going to auction, and we'll cover that in a bit more detail, I suspect later, there's two categories: whether they're buying a particular property that they're very fussy about, and if they don't succeed at the auction, they will hand the bond back and walk away and take months to find something else that's relevant for their style. Or the second category is somebody who's fronting up to any number of auctions, and they'll continue going to an auction until they're successful. So there's a couple of different paths when it comes to auction bonds. And then, of course, we've got off the plan. Off the plan are where you're buying land or an apartment that's going to be constructed or made ready over 12, 24, 30, 40, 60 months, whatever the case may be. And that bond process is a little bit more complicated because there's no finance being approved. You don't get your finance approved till closer to settlement. So we have to go through a more thorough, not dissimilarly to actually getting a bank loan.
Right. But you said a really interesting thing. So there is a style of bond that is not property specific, but is effectively transaction specific.
That's right. And that's mainly the open bond. That's for somebody who is going to be fronting up to any number of auctions. And it can also be used for private treaty if they happen to stumble across something outside of the auction process. And the beauty, of course, is the open bond is that you're prepared, you're ready, you're there. And if you're successful, you immediately pull out the piece of paper and then hand it over and you secure the property.
And how long can those bonds be open for? Is there a time limit on them?
Two categories. If you've got unconditional finance approved or pre-approved, the banks most likely give you 90, 126 months grace for that for that finance offer. So for established property and for unconditional finance approved, that category we issue out to 6 months. For all other bonds, we can go out to 66 months. And indeed, for some of the big developers like the Mirvacs, the land leases, those sorts of phrases, we can go out to 84 months, so 7 years.
Right. So basically what that means is a purchaser could have in their back pocket a deposit bond certificate from you and, go around from auction to auction over a period of time. And if they trip over the right deal at the right point, they can just pull it out and say, ta-da, and off they go.
Yeah.
Right.
Yeah. Up front, we identify what is the maximum amount you're going to go to. So if they say to us, we're only going to bid to $1 million, and it's going to be a 10% deposit, we make the bond out for $100,000. Now, if they get a bit excited on the day and bid a bit more, they'll either get the vendor to agree that 100,000 is close enough, or they'll top it up with a bit of cash. If it goes for 950,000, well, the bond in the second part of the wording actually says the bond can never ever be greater than 10% of the purchase price. So it just automatically drops down to 95,000.
Right. Now, I'm assuming that this doesn't come for free, though. There must be some costs, and you've got to make money in this process too. So how does that all work?
Okay, well, essentially, QBE is the provider. They're the ones that set the rating structure, so we use their rater. Essentially, as an example, let's say we're talking $500,000 purchase. A $50,000 bond for up to 6 months would cost $575 plus credit card merchant fee. If you're talking a $50,000 bond, say up to 24 months for an off-the-plan land or apartment, you're talking around $3,300.
Right.
And that's paid up front.
Okay. And that's interesting because I suppose the other way to think about it, if I was taking money out of my bank account, and losing interest on that would have cost me something. So, in fact, the fees don't sound as though they're particularly huge.
No, they're not. Obviously, the fees aren't as competitive in this environment where the interest rates are down very low. When interest rates are the normal up around the 7, 8, 9%, obviously it becomes far more attractive. But still, in all, the majority of people don't have idle cash lying around. So for the most, and they have to move quickly. And if they try to go and get a bank guarantee, that takes time and effort and delays. So most people, we rarely come across people who really balk at the price because they realise that it's value added. It's a win-win scenario because they don't have the cash, they can't free up or convert other assets to cash quickly. So there's a huge convenience factor.
Right. So it sounds to me as though that convenience factor, that flexibility factor, and as you say, you don't have to go and find funds from Bank of Mum and Dad or from the bank down the road or whatever it is. You can pretty much go unencumbered. Now, do you have to be an Australian citizen to get this, or a resident? How does that work?
Yes. Australian Australian resident or have a permanent visa, and it also covers individuals, trustees, self-managed super fund, first home buyers, companies, partnerships. So basically, if there's a real estate deal on the go, residential or commercial, then the deposit bond's going to fit the equation. If you're a new person to Australia and you're from New Zealand and you own an asset in New Zealand, we can look at that. But if you're from other parts, no, we can't. Just to clarify something, and it's important to distinguish between the two. If you go and get a bank guarantee, the bank needs to secure that against some asset or some term deposit. So it's basically what they call secured. With deposit bonds, they're unsecured. So QB is not taking registration or mortgage or anything title over any asset. So that's why property needs to be in the background, so that if there is a call, the person has got the ability to refinance to be able to pay back QB if they don't have the cash to pay back immediately.
Okay, now that's very interesting. And I guess the other scenario is, what happens if you take out one of these bonds and then you go to, go to buy, but you're not successful, and then you want to unwind it? Are there penalties to do that, or can you unwind it? How does that work?
Yes, you can. Yes, you can. So if we talk again about an established property, you front up, you put the bond down, we issue the one, you put the bond down, then you find there's an issue with the contract or a building inspection or something, pest inspection, and then the contract's rescinded, you'll get your money back less our issue fee, which is around $400.
Okay.
If you are going to an auction, there is no refund, because we're giving you the privilege of being able to attend any number one of auctions and put you in a position where you can play at the auction rather than just standing on the sidelines. Where it's an off the plan, then obviously once the bond is secured against a particular contract, there is no refund other than always with an off the plan, there is an extended sunset date or a registration date, and that's a buffer past the anticipated completion date, and that's put in mainly or driven by the funders to the project to ensure that if something goes wrong during the construction phase, such as bad weather delays, there's some damage to the building, they always put a buffer zone in between the anticipated completion date and the sunset registration date. So if you're in that scenario, yes, you get a pro rata refund back from the date you settle through to the expiry date that's on the bond, noting that our observation is that the majority of projects never settle on the anticipated completion date, because that tends to be a good marketing exercise, but they do certainly settle well short of the sunset date, registration date.
Yeah, that's very interesting. Now, I suppose the other interesting question is, how widely accepted will these bonds be? I mean, who determines whether the vendor is going to accept it or not?
Look, they are widely accepted, all the way from small vendors, small-scale vendors, up to multi-million-dollar vendors, from small developers to the big end of town developers. So they are widely accepted. However, it is always up to the seller or vendor whether they're going to accept the bond. Now, we have seen some scenarios where the seller wants cash because they want to use that cash to use for them to go and secure the next property, which is always a bit of a dangerous trick, particularly if the contract's going to get unwound. And also, too, some real estate agents try to push cash because they want to get their commission early rather than having to wait till settlement. So, but in the main, they are very, very widely accepted.
Right. And how quickly can a bond be established? I mean, does it take weeks, or is it literally a phone call? How does that work?
No, it's basically, there's an online or offline application process, and as long as we've got the application form correctly completed, the couple of support documents we need, and we can take money off a credit card, it can be out the door within an hour. If the person wants to pay by electronic funds transfer, that depends on the bank timing, but it could possibly be the same day with the new RBA clearing system, or it might be overnight the next day.
Okay, right. So there's no long lead-in. I'm just thinking of, in the mortgage application process, you have to allow plenty of time for the banks to go through their processes, but it sounds as though your process is a whole lot slicker.
Yeah, very, very fast. And we need to, because without any due disrespect to your audience, quite a few leave it to the last minute. So particularly off the plan, and they leave to the last minute. So there's a bit of a rush. I've got to have the bond to the vendor side by 5 o'clock Friday afternoon. Or they come to us on Friday afternoon and say, I'm going to auction tomorrow, I need a bond. So we're normally up against the wall in terms of timing.
Yeah, now some would say that's very Australian, a bit last minute. That's just the way things go.
She'll be right, mate.
Yeah, well, there is that definitely around the place. Okay, let me just sort of drill down slightly further. Let me just take a few examples then. So let's talk about the auction example, right? So there, what you've got is a bond that allows you to bid or not, and allows you to transact or not. Are there some specific parameters around that, and or how does that work in practice?
No, the parameters are the same across the board in terms of how we assess things, but the look of the certificate differs. If you're talking about, and I'll just add an extra one to it, if you're talking about an established property where the price has already been agreed, then you'll find on that certificate the buyer's name, the seller's name, the property location, the purchase price, both in figures and numeric, and then in the second paragraph you'll see the bond amount in words and also numeric. So all the boxes are filled in. If you've got somebody who's going to buy a particular auction, a particular property, as I mentioned earlier, and they're going to walk away and take months to find something else if they're unsuccessful, then the buyer's name, the seller's name, the property address are filled in, but the purchase price and the is left blank, because that's not going to be known until the auction finishes. But in the second paragraph, we know that the person said we're only going to buy up to $1 million, so that'll have 100,000 in there being the cap that the bond will honour. And of course, the third category then, of course, is the open bond. Now, if the open bond, the only field completed in terms of the first paragraph is the buyer's name. The seller's name is blank, the property address is blank, the purchase price is blank, because guess what? They don't know which property they're going to get. So they're all blank. The second paragraph does have that 100,000 cap, because that's the maximum amount the bond will honour at the auction.
Great. Now, what would you say is the number one benefit of a deposit bond?
Number one ranks equal would be speed and not having to scratch around for cash. So there's it's efficiency. If you don't want to get gazumped, then you've got to get something turned around in a couple of hours and get it into the hands of the seller side to stop being tossed off the contract. Yeah, speed. Yeah, speed is the main thing. And as you mentioned, the other point is if you go into an auction, it's the flexibility. You can carry this bond around. You obviously don't show the bond to anybody, because that's showing your hand as to how much you're prepared to bid up to. But you just keep it in your folder, and if you're successful, you can then immediately hand it over and just sort out the auction being pulled and being referred to other interested parties.
Why do you think it is that deposit bonds are hardly spoken about in Australia?
That's right, and I've been in the game now since I was attached to something in 2000, but mainly with Aussie Bonds. I've been driving that since 2007, and yeah, coming from the finance field, it sort of amazed me at the lack of sort of awareness. So it's through channels like yourself that we can get the word out, because they're an incredibly handy tool.
And it doesn't seem to me that I've asked a few estate agents, real estate agents, but they're not aware of them.
Well, they're either not aware of them or they choose to ignore them, because, as I said, a lot of we come across real estate agents that would rather get cash and get their commission up front and not have to wait 2-3 months before the property settles so they get their commission. So, because, as I said, the bond is a piece of paper. It's not, there's no cash being paid up front, so the agent's not able to get his early commission. So, but you're right. There is a large amount of unawareness out there, particularly amongst the younger people in the trade.
Right. Well, you see, I've got this theory that part of it is just lack of awareness, but I think that structural issue you've just touched on, which is that real estate agents are used to trying to get the commissions through early, could actually be a barrier, because actually it's in their interests to go for cash rather than the bond, despite the fact that the bond might actually be the best way to achieve a sale. So there's a bit of an education process there, I think, for agents.
Well, absolutely. And the other thing I would highlight too is, and we've seen it happen sadly on a number of occasions, is putting down a cash deposit on an off-the-plan purchase for land or an apartment. We've seen, because these take 24, 30, 36 months to complete, or build and complete, and then head to settlement. And the problem is, in that course, or during that course, the builder could go under. So if the builder goes under, then everything's frozen, including, let's say you've put down 100,000 cash for $1 million apartment, then that 100,000 is frozen. And now hopefully it's sitting in the trust account for it to be released at some later point. But yeah, that'll be tied up whilst the whilst the receiver works out, well, how far is the project advanced? Do we bring another developer in to take that project over to completion, or do we rescind the contracts and then finally hand back the cash? But that can be 18 months, 2 years or more before all that gets sorted out. So here's a person sitting back, no property, 100,000 cash sitting in some trust account somewhere and waiting patiently.
Very patiently indeed.
Yes.
and how many providers are there of these bonds in the Australian market?
There's only two. There's QBE Insurance, and then there's another group called Asset Insure, and they've got a South African insurance company behind them. But yeah, it's a limited space, mainly because this particular product can't be shifted off the balance sheet. It can't be, it's basically whatever the exposure is, it can't be reinsured away or transferred away. So it means more capital has to be allocated for the bond. So, but also, having said that, deposit bonds are part of a broader, what they call surety space, and people might have heard of contractors' bonds, performance bonds, tender bonds. So they're all part of the big family. But deposit bonds is a small part of that bigger pool.
And how does the regulation work? Is it ASIC? Is it APRA? Is it a combination of the two of them? How does that work?
It's primarily APRA. QBE is governed by APRA. But having said that, deposit bonds are actually a financial instrument. They're not a financial product. So they're the same as a bank guarantee. It's an instrument. But having said that, QBE is assessed on the same criteria as Westpac, and the other big three banks. And they've got an A+ credit rating, similar to the others. So they stand to be assessed on the same basis. Right. So deposit bonds are just as secure as bank guarantees.
Okay. And presumably there is the same disclosure issues and product disclosure statement or something similar, which means that there's a set of documentation that comes with the bond so that everything sort of pins down as it were.
Yeah, that's right. As part of the application process, the applicants are provided with a number of documents, including quite clearly what they're getting into, because what they're signing up for is they're basically indemnifying QBE. Yes. They're saying to QBE, if a seller or vendor calls the bond and you've got to pay away 100,000, then yes, we're liable back to you for that 100,000, and also for any legal costs or interest costs if they don't settle up quickly or come to some arrangement.
Yeah, absolutely. So the way I think about it is basically it's a tool to shift the timing of that 10%, right? But they're still liable for it at the end of the day. Absolutely. They can't walk away from it. Yeah. And as you say, if things go wrong, then they're liable for that 10% plus all the other fees and charges and bits and pieces around the edge, just as they would be in the normal course of events.
That's right. Right. As you've identified, if they had to put up 100,000 cash, then that 100,000 cash is just withheld and they're out of pocket and they're not getting any of that back.
Great. Well, last question, I guess, is if people want to find out more about this, where do they go?
Well, essentially, our website is homedepositbonds.com.au. I suggest for those that might have missed a few points today, may want to go to frequently asked questions. It's very comprehensive. Then they can obtain an online quote. They just tick a few boxes, and that will be emailed to them and gives them a further extensive information. And then if they want to proceed, then they can proceed by way of either online or offline application. And there's a tool to be able to post support documents into like a mailbox, et cetera, et cetera. So it's and of course they can then obviously call me as well if there's any issues. And also importantly, we have as long as they identify themselves during the process, we will be giving a further discount for DFA members.
Oh, audience. Well, yeah. Mention DFA, folks. You might be able to get.
Yes, absolutely.
Yeah, I get nothing from this, but you may well benefit from it. And look, Kerry, I think that's a really interesting conversation, and it's, as I say, something which I think people probably have never heard of and probably should. I think this is a very interesting proposition, and in some cases will make a significant positive difference to people's buying experience. So I appreciate your time today, and we'll put all the links and things below, and hopefully people will be a little bit more informed about the bonds and particularly deposit bonds.
Well, certainly appreciate the opportunity, Martin. Thank you.
Great to talk to you. Thank you very much, Kerry. Take care.
Indeed. Bye. All the best.